Stablecoins are moving from regulatory gray area to supervised financial infrastructure. In this section, we'll use the Genius Act to understand who can issue them, what must back them, and how users are protected. So far, we've covered the shift from broad regulatory uncertainty to stablecoins as infrastructure, and then the Clarity Act's market structure framework. Now we turn to the Genius Act, which focuses specifically on payment stablecoins, eligible issuers, reserve requirements, and user protections. The strategic importance of the Genius Act is that it moves stablecoins out of a gray zone. A payment stablecoin is not just a crypto token. It can function as a settlement rail, treasury tool, market liquidity instrument, and consumer payment product. That changes the business question. Issuers must think about who supervises them, what reserves they hold, what disclosures they make, and how audits work. For executives, the issue is not simply whether stablecoins are useful. It is which regulated model makes issuance, partnership, or adoption operationally viable. The Genius Act starts by narrowing the target: payment stablecoins, not every crypto token. A payment stablecoin is designed to hold stable value, usually against the US dollar, and to move value in payments or settlement. That promise depends on reserves, redemption rights, and issuer controls. It is different from tokens bought for investment, governance, utility, or exposure to real-world assets. The more a coin is presented as safe, redeemable, and cash-like, the stronger the case for dedicated oversight. In practice, the definition determines who must comply. Issuer eligibility is one of the Genius Act's main gatekeeping tools. The question is not just who wants to issue a stablecoin, but who can safely issue a cash-like liability. Banks may qualify through existing prudential oversight. Non-bank fintechs may qualify if they receive approval and meet federal standards. Some state-regulated issuers may also qualify if the statute's conditions are met. Across these categories, the core tests are consistent: sound reserves, reliable redemption, compliance controls, risk management, and reporting. These rules also shape the market by influencing whether issuance becomes bank-led, fintech-led, or hybrid. Supervision is not just a legal formality. It shapes the stablecoin business model. A federal path offers consistency, especially for issuers operating nationally or at large scale, but it may bring heavier compliance expectations. A state path can build on existing money transmitter or trust company licenses, often helping newer issuers move faster. The hybrid path tries to combine both: state oversight plus federal baseline standards. The trade-off is clear. Issuers gain certainty and scalability as supervision becomes more uniform, but usually with higher cost and more scrutiny. Choosing an issuer model is a strategic decision, not just a legal one. Banks start with advantages in supervision, compliance systems, payment access, and customer trust, but they may move more slowly and face institutional constraints. Non-banks can innovate faster, reach digital users more naturally, and build modern product experiences. Their challenge is proving they can meet licensing, reserve, and oversight expectations. For many firms, the winning model may be partnership: bank credibility combined with fintech speed, distribution, and technology. Reserve quality is what makes a stablecoin feel like money rather than a promise. If every token is backed by cash, short-term treasuries, or similarly liquid assets, users can expect one-to-one redemption even under stress. But if reserves include hard-to-sell assets, long-duration exposure, or unclear holdings, confidence can break quickly. That is when redemption pressure turns into run risk. The Genius Act's reserve focus is meant to keep backing simple, transparent, and immediately available, so the stablecoin can function as a reliable payment instrument. Segregation means the reserve assets backing tokens are legally and operationally separated from the issuer's own money. That matters because customer backing should not be available for payroll, marketing, lending, or speculative investments. A qualified custodian adds another control layer by holding reserves in accounts with defined permissions, records, and oversight. If the issuer gets into financial trouble, clear segregation helps show that reserves are dedicated to redemption obligations, not general corporate creditors. In practice, reserve management becomes more than a corporate promise. It becomes a protected governance structure. Redemption is where a stablecoin's promise becomes real. A holder submits tokens and expects dollars back at par, unless different terms were clearly disclosed. The issuer checks eligibility, applies any limits or fees, removes the tokens from circulation, and pays cash, liquidating reserves if needed. Each step must be predictable, especially under stress. If users face delays, surprise costs, or unclear rules, confidence can break quickly. That is how a redemption problem can become a market depeg, even before reserves are fully exhausted. Reserve promises only matter if the market can verify them. Regulated stablecoin issuers are expected to disclose what assets back the tokens, how many tokens are outstanding, where reserves are held, and how redemption works. Independent attestations or audits add another layer of confidence by testing whether the reported reserves are sufficient and properly composed. The goal is not paperwork for its own sake. Transparency lets users, partners, and regulators assess solvency, custody risk, and operational discipline before trust becomes a crisis. Consumer protection under the Genius Act is about preventing confusion before it becomes harm. Imagine a fintech advertising its stablecoin as safe as a bank deposit. If there is no deposit insurance or government guarantee, that claim can mislead users. A better approach is plain language disclosure. What backs the token, how redemption works, what fees apply, and what limits exist. The issuer also needs to keep customer assets separate from its own funds, so insolvency or operational problems do not blur ownership. Finally, support matters. Clear complaint handling and error resolution turn legal compliance into practical trust. Run risk starts with confidence. If holders begin to doubt an issuer's reserves, redemption requests can accelerate quickly. To meet those redemptions, the issuer may need to sell reserve assets fast, which can create losses, depegging pressure, and stress in short-term funding markets. Scale is the key amplifier. A small failure may remain isolated. A widely used stablecoin can affect payments, liquidity, and consumer confidence more broadly. The Genius Act safeguards are meant to reduce that chain reaction by requiring stronger reserves, supervision, and stress readiness before problems spread. For executives, stablecoin readiness is a business plan, not a legal memo. Start by deciding your role: issuer, integrator, custodian, merchant acceptor, or partner. That choice drives the regulatory path, including bank relationships, federal oversight, state licensing, or reliance on third-party issuers. Then test whether operations can support reserves, disclosures, redemption, compliance reporting, and incident response. Companies that build these capabilities early can move faster in enterprise payments, tokenized asset settlement, and customer-facing products, while competitors are still waiting for clarity. To wrap up, the Genius Act gives us a stablecoin-specific framework: eligible issuers, strong supervision, high-quality reserves, clear redemption rights, and meaningful disclosures. The core idea is trust. Users need confidence that a token is backed, redeemable, and responsibly managed. Next, we shift to the Stable Act, where the focus expands to risk, banking boundaries, and compliance.